Welcome to the Deep Dive, the show where we cut through the noise and really extract the vital signals from the latest information. We want to help you get well-informed fast.
Exactly.
So today we're taking a deep dive into the recent quarterly conference call from Kinder Morgan. You know, a real giant in North American energy infrastructure.
Absolutely, a critical player.
And our mission for you really is to quickly grasp the key financial takeaways, the strategic insights, and, well, what this all means for their future outlook, without you having to wade through hours of dense transcripts.
Yeah, let's jump right in. And if we zoom in on that financial snapshot from the last quarter, Kinder Morgan reported some really robust growth compared to Q2 2024.
Robust how?
Well, their adjusted EBITDA, that jumped by 6%, and adjusted EPS climbed an impressive 12%.
Okay, 12%, wow. And what really caught my eye was the net income attributable to KMI. I mean, it surged a remarkable 24% to $715 million.
Right.
Pushing their EPS to 32 cents. That's up 6 cents year over year. And even if you pull out some of those one-time items that can sometimes, skew the picture.
Yeah, the adjustments.
Exactly.
Yeah.
Their adjusted net income still landed at a strong $619 million, up 13%, and adjusted EPS at 28 cents, still a solid 12% increase. So this isn't just a fleeting blip, is it?
No, precisely. And what's particularly insightful here is that this isn't a one-off, like you said.
Yeah.
This growth, it was fundamentally fueled by new natural gas expansion projects, a key strategic acquisition, that Outrigger deal, robust natural gas capacity sales, and just consistent, strong performance from their Jones Act tankers. These aren't temporary boosts. They feel pretty foundational.
But looking ahead then.
Yeah, looking ahead. For the full year 2025, the company actually expects to exceed its original budget.
Really?
Yeah, at minimum by what Outrigger is contributing. So this means their projected adjusted EBITDA growth for 2024, it's now looking more like 5% instead of the original 4%. While adjusted EPS growth holds steady at a very attractive 10%.
Okay. And for anyone watching the bottom line, that dividend.
Right. The board declared a quarterly dividend, 29.25 cents per share. That annualizes to $1.17 per share.
Which is a bump.
Yep, a 2% increase from their 2024 dividend. Plus, their balance sheet looks incredibly solid. Net debt stands at $32.3 billion. And crucially, that net debt to adjusted EBITDA ratio improved. It's down to 4.0 times.
Down from 4.1 times right after the Outrigger deal.
Exactly. Down from 4.1 in Q1 post-Outrigger, and they're anticipating ending the year rounding up to 3.9 times.
Now, for those maybe less familiar with these ratios, what does that 3.9 or 4.0 times actually tell us? What's the significance there?
That's a critical question. Look, for a company like Kinder Morgan, which relies pretty heavily on debt for these big infrastructure projects, that net debt to EBITDA ratio is a key measure of financial health.
Okay.
So dropping from 4.1 to 4.0 and looking towards 3.9, it shows a strengthening balance sheet. It shows an improved ability to manage their debt load relative to their earnings.
So, more breathing room.
Basically, yeah. It signals to lenders, to investors, that they're generating ample cash flow to cover their obligations, which, de-risks the company profile.
And people are noticing.
Oh, definitely. That discipline is clearly resonating because credit rating agencies are taking serious notice. Moody's put KMI on a positive outlook in June.
Following S&P.
Following S&P, who did the same earlier in the year. And this improved outlook, it has a tangible benefit.
What?
Better credit spreads. It means they can borrow money at lower rates.
Okay, that's a strong financial picture laid out. But what's truly driving this momentum, and maybe where are they looking to expand next? I'm particularly curious about the bigger macro trends, especially, how the U.S. is positioned in the global natural gas market.
That's a fantastic place to start. Management really leaned into the significant international growth in natural gas demand. They even cited a chief economist from a major oil company who projects a staggering 25% global increase over the next 25 years.
25% increase globally. Wow.
Yeah, and this isn't just wishful thinking. It's driven by very real factors. We're talking substantial worldwide population growth, especially in emerging markets across Asia and Africa.
Where energy needs are just huge.
Exactly. Energy needs are acute, and local production simply can't keep up. These regions need energy, and liquefied natural gas, LNG, is expected to satisfy the bulk of that additional demand. It's expected to grow much faster than overall natural gas demand.
And here's where it gets really interesting for the U.S., right?
Yeah.
I mean, think about it. The U.S. has been cranking out more natural gas than anyone else on the planet for 15 straight years?
15 years running. Undisputed leader.
It's like the heavyweight champion of gas production. And since 2023, we've also been the world's top LNG exporter. They even highlighted how recent geopolitical shifts, particularly in the Middle East,
Right, that adds another layer.
it further enhances the reliability and security of U.S. supply for international customers. So what does this actually mean for Kinder Morgan on the ground?
It means they're positioned right at the heart of this global energy shift. Look, S&P Global Commodity Insights projects U.S. LNG feed gas demand to increase by 3.5 billion cubic feet per day this summer compared to 2024.
3.5 BCF a day increase just this summer.
Just this summer. And to put that in perspective, that's enough gas to power millions of homes daily. And by 2030, that demand is projected to more than double.
Double by 2030.
More than double. And Kinder Morgan, as a critical pipeline operator, already moves approximately 40% of all the feed gas for these burgeoning LNG export facilities.
40%, that's a huge slice.
It's massive. So as the U.S. solidifies its role as a global energy supplier, KMI is perfectly situated to benefit from that increasing flow.
Okay, so powerful macro trends. But beyond that, there are also some, surprisingly favorable regulatory tailwinds at play, which is always a big deal for these kinds of infrastructure projects.
Yeah.
They noted an improved federal permitting environment. The U.S. Army Corps of Engineers, for instance, issuing permits quite quickly. But what really stands out are those recent FERC actions. Can you break down how those impact Kinder Morgan's ability to actually get projects done?
Absolutely. Think of it this way. FERC, that's the Federal Energy Regulatory Commission, they basically just raised the speed limit for smaller projects.
Oh, yeah.
They increased the prior notice limit by 50% to $61 million. What that means, practically, is projects below this threshold no longer require a full 7C filing, which is a much more extensive and time-consuming regulatory approval process.
So faster track for smaller but still significant projects.
Significantly faster, gets them off the ground quicker. Furthermore, there's been a 1-year waiver of the 5-month waiting period between getting the permit and actually starting construction.
And they think that might stick.
There's optimism it might become permanent, yeah. And if we connect this to the bigger picture, there's an anticipated Supreme Court ruling on NEPA, the National Environmental Policy Act. The expectation is it will narrow the scope of environmental reviews and make, nuisance lawsuits more difficult. So taken together, this potentially de-risks large infrastructure projects, making them faster and more predictable to execute.
It sounds like a pretty significant shift in the regulatory landscape.
Yeah.
Makes deploying capital much more efficient.
Yeah.
And speaking of capital, let's talk about taxes and allocation. There are some significant tax benefits coming their way.
Yes, that's right. The recent budget reconciliation bill is set to deliver substantial cash tax benefits in 2026 and 2027.
How substantial?
Well, KMI doesn't expect to be a material cash taxpayer until 2028, largely thanks to a full expensing provision.
Okay, full expensing. For our listeners, what does that actually mean for a company like Kinder Morgan? And how does this affect their investment strategy, if at all?
Right. Full expensing is a powerful tax incentive. It essentially allows companies to immediately deduct the full cost of certain capital investments, like pipelines or facilities, rather than depreciating them over many years.
So bigger deduction up front.
Exactly. For an infrastructure company like KMI, which invests billions, this means a much lower taxable income in the short to medium term, resulting in significant cash tax savings.
And what are they doing with that extra cash? Changing strategy.
Management was pretty clear on this. They said it doesn't change their disciplined investment strategy or their return thresholds. They emphasized that for projects with good returns, capital availability simply isn't a constraint.
So no shortage of good projects or cash to fund them.
That's the message. It suggests they'll use this enhanced cash flow either to fund more attractive projects internally without needing to raise external capital, or potentially return more to shareholders. It signals financial strength, but without compromising their investment discipline.
So with these favorable tax tailwinds and a disciplined approach, where is Kinder Morgan actually putting its money to work? Let's look at that project backlog, because that's where we see the future vision taking shape.
It grew, right?
It did. It grew from $8.8 billion to an impressive $9.3 billion this quarter.
Okay, $500 million increase. What's in there?
Well, they added $1.3 billion in new projects while placing $750 million into service. So net growth. Key additions include Trident Phase 2 and the Louisiana Line Texas Access Project.
What does that one do?
It's critical for moving natural gas from the Katy hub in Texas directly to the booming Louisiana LNG market.
And then base.
Pretty much. They also secured 2 NGPL projects designed to serve new power plants, one in Arkansas and one in Wisconsin. This highlights that diversifying demand base we mentioned.
Power generation demand is becoming key then.
It's fascinating. Approximately 50% of the current backlog projects are specifically for power demand. That's a significant chunk, moving beyond just traditional industrial or residential uses. And the backlog multiple for those tracking is around 5.6 times, which means
For an infrastructure company, that's generally seen as a strong indicator of high-quality, profitable projects in the pipeline.
so their core strategy, it sounds like it remains very much intact.
Yeah.
Owning and operating stable, fee-based energy infrastructure assets.
Right.
Deploying significant cash flow into attractive return projects, returning capital to shareholders, and maintaining that strong balance sheet we talked about.
Exactly. It's a consistent and well-articulated strategy built on predictability.
And we see that consistency across the business segments.
Yes, largely. In natural gas, transport volumes were up 3%. That was primarily driven by those LNG deliveries on their Tennessee gas pipeline and the Texas interstate system.
Oh.
Gathering volumes were down 6%, with the biggest impact seen in the Haynesville Shale. But they're projecting growth there over the rest of the year.
Why the turnaround?
Due to higher prices and, again, that increasing LNG demand pull. In fact, they estimate Haynesville production could actually double by 2034.
Double. Wow. Okay. What about other segments?
Moving to products pipelines, both refined products and crude condensate volumes saw a solid 2% increase. Pretty steady.
And terminals.
Their terminal segment reported liquids lease capacity remaining high, about 94%. Strong rates and utilization at key hubs like the Houston Ship Channel and New York Harbor. And their Jones Act tanker fleet.
Yes, the U.S. flagged ships.
Right. Those ships that can only transport cargo between U.S. ports. That fleet is fully leased through 2025 and nearly fully leased through 2027. And they've extended the average contract lengths out to 4 years.
So locking in that stable revenue.
Exactly. That domestic focus often means more stable and predictable revenue streams.
Anything else segment-wise? CO2.
And finally, the CO2 segment. It experienced slight decreases in oil production and CO2 volumes. However, what really stands out is their NGL volumes, natural gas liquids, were up a significant 13%.
13% up in NGLs.
Yeah. This suggests KMI is effectively diversifying within this segment, extracting more value from the liquids inherent in natural gas. Those can be higher value products. It's a smart way to leverage existing infrastructure in a dynamic market. It speaks to the diverse and increasingly optimized portfolio Kinder Morgan is managing.
It's clear they're not just, riding the waves. They seem to be actively trying to make them.
Oh, my God.
Let's delve into their commercial competitiveness and maybe future opportunities. KMI attributes their success to their huge existing asset footprint, a strong track record of actually delivering projects, and robust customer service. But what kind of new frontiers are they looking at? Where's the next big thing?
They're clearly thinking big. Discussions are ongoing for massive projects like the Copper State Connector.
In Arizona.
Exactly. Estimated to be a $4 to $5 billion project addressing significant natural gas needs in Arizona. Not just for traditional utilities, but also for potential data centers.
Data centers. The energy hogs.
Precisely. And this brings us to a fascinating area. The company is actively pursuing behind-the-meter opportunities, particularly with regulated utilities, and exploring broader partnerships to bring supply and storage directly to key sites for hyperscalers.
Okay, you threw out some jargon there. Behind the meter and hyperscalers. Can you demystify those for us?
Good point. Hyperscalers, think of the massive data center operators. The giants like Google, Amazon, Microsoft, they have truly enormous and constantly growing energy demands.
Right.
And behind the meter means supplying energy directly to the customer on their property, often bypassing the traditional utility grid entirely. It's about creating a very direct, dedicated energy solution for these really energy-intensive operations.
Interesting. Direct supply.
Yeah. And beyond that specific niche, they're also seeing robust incremental project opportunities popping up in Arkansas, Texas, the Midwest corridor, and the Southeast, so confirming pretty broad demand growth.
So shifting back to LNG and the gas supply itself, while much of the new LNG demand is concentrated on the Gulf Coast, which obviously increases capacity usage on their Tennessee gas pipeline, are they looking beyond just the Haynesville Basin to supply all this? What's their strategy there?
Their approach seems to be truly all of the above. They see the lean Eagle Ford Shale Basin down in South Texas as particularly important for Texas LNG facilities.
By the Eagle Ford.
Because of its low nitrogen gas quality, that's highly desirable for the liquefaction process. They're also actively evaluating opportunities to move incremental gas from the Utica and Marcellus basins.
Up in the Northeast.
Right, up in Appalachia, moving it south using their extensive Tennessee gas pipeline network. So it's a multifaceted basin approach, trying to minimize reliance on any single source or market.
Makes sense.
Yeah.
Diversify the supply.
Exactly. And it involves not only feeding those LNG export facilities, but also supporting growing power demand, existing local distribution company or LDC needs, your local gas utilities, and just basic power generation across their footprint. They also, interestingly, addressed potential Permian overbuild risks.
Yeah, you hear about that sometimes. Too many pipes.
Right. But they seem pretty confident, stating their strategic asset positioning and conservative financial assumptions for recontracting ensure stability, even if the market gets crowded.
Okay, this has been a really comprehensive picture of Kinder Morgan. So let's try and synthesize this. What does this all mean for you, the listener, the person trying to stay ahead of the curve here?
Well, I think this deep dive really underscores the enduring strength, or at least the perceived enduring strength, of the natural gas sector. Kinder Morgan themselves highlighted what they're calling their best opportunity set in 24 years.
24 years. That's a bold statement.
It is. And it's driven by that strong secular demand growth we discussed, both global and domestic, and crucially, what seems to be a significantly more favorable regulatory environment right now.
And that substantial increase in their project backlog, especially with, half of it dedicated to power generation, that signals a diversifying demand base, right? Beyond just traditional industrial or residential uses.
Absolutely. It clearly reflects the evolving needs of, the energy system, maybe even the energy transition itself, and their strategic emphasis on leveraging existing infrastructure for project wins, that provides a powerful competitive moat.
How so?
It potentially allows for more capital-efficient expansions compared to building entirely new greenfield projects from scratch. Using what you already have is usually cheaper and faster.
Makes sense. And for those keeping an eye on the financials, those positive credit outlooks from Moody's and S&P, combined with the anticipated tax benefits and their discipline to capital allocation, it really seems to reinforce a strong financial foundation.
Agreed. And finally, those insights into behind-the-meter opportunities, particularly concerning data centers, that really signals a forward-looking approach, trying to tap into emerging high-growth energy demands.
All right, let's pivot. Time for our This Is Not Financial Advice segment. This is where we explore how a sophisticated investor might synthesize these insights into a conceptual approach. Purely a thought experiment, okay? Not advice. Think of it like a hedge fund analyst pitching an outrageous but plausible trade idea to an investment committee.
Okay, let's play that game. Given the robust long-term outlook for natural gas demand, particularly from global LNG and domestic power generation, alongside Kinder Morgan's stated ability to finance attractive projects with internal cash flow and that strengthening balance sheet, a conceptual approach could be something like a leveraged long position on KMI, coupled with a long-dated out-of-the-money call option on a pure-play LNG developer.
Okay, break that down. Leveraged long KMI plus an LNG call option. Why?
The thesis here is kind of twofold. KMI acts as the relatively stable infrastructure backbone. It benefits from increased volumes pretty much regardless of which specific LNG projects ultimately come online first or win out. It gives you exposure to the whole value chain with more predictable fee-based revenues.
The backbone play.
Right. And those substantial tax benefits coming in 2026, 2027, that means more free cash flow, which can either be returned to shareholders, making the dividend maybe more secure or even grow, or deployed into further attractive projects fueling growth without needing external capital calls.
So KMI is the safer income-generating base. What about the LNG call option piece?
The specific LNG call option then offers a high beta, more aggressive bet. It's a way to play the potential doubling of U.S. LNG export capacity by 2030 that the forecasts talk about. It aims to capture explosive upside if the most ambitious projections for global demand and U.S. supply materialize faster or bigger than the market currently prices in.
So it's like conservative income with an aggressive, highly leveraged growth kicker attached.
Conceptually, yes. It's a way to think about benefiting from both the predictable fee-based model and the potentially exponential growth of a major macro energy trend. Again, just a hypothetical construct.
Absolutely, just a thought experiment.
Yeah.
So to recap our deep dive today, Kinder Morgan delivered a solid quarter. Strong financials, a rapidly growing project backlog fueled by surging natural gas demand, and, interestingly, significant tailwinds from an improving permitting environment and new tax legislation.
Yeah, the company appears strategically positioned to capitalize on long-term global and domestic natural gas demand, especially from LNG exports and power generation, really leveraging its huge existing infrastructure footprint.
And remember, folks, this discussion, this deep dive, it's for informational purposes only. It is absolutely not financial advice. Please do your own research. So, as we look to the future, Kinder Morgan seems to be betting big, doubling down really, on natural gas as a long-term energy solution, even as the world pushes hard for renewables. This raises a fascinating question for you to think about. In this rapidly evolving energy landscape, how long can traditional infrastructure giants like Kinder Morgan continue to ride the wave of fossil fuel demand? And maybe more importantly, what role do you see them playing, if any, in a truly green energy future down the road?
That's the multi-trillion-dollar question, isn't it?
It really is. We'd love to hear your thoughts on that or anything else from today. What insights did you find most compelling? Reach out and let us know.